Welcome back, guys. In continuation to my last video, as I told you, we are going to do a question on income statement prepared under absorption costing and under marginal costing. So I've taken up a question. Let us read the question and understand. Before starting any question, it is very important to understand what information is given in the question and what is the requirement of the question. XYZ Limited has a production capacity of 2 lakh units per year. It has a production capacity. This is the installed capacity. Now, normal capacity utilization is reckoned at as 90%. That means normally the company or the organization utilizes 90% of this capacity. So if I take 90% of this capacity, 2 lakh into 90 means the normal capacity is 1,80,000 units. Now, I would always prefer, as we are reading the question, it is always better to start writing our working notes or whatever information is required. So, first working note. So, I've taken some beautiful colorful pens for you guys. So, working note 1. Calculation of normal capacity. These all things will be required. Now, calculation of normal capacity. So we have installed capacity as 2 lakh units. So 90% as normal capacity would be 2 lakh into 90%, that is equal to 1,80,000 units. Now let us go ahead. Now the question says standard variable production cost is rupees 11 per unit. Fixed cost are rupees 3,60,000 per year. Variable selling cost are rupees 3 per unit and fixed selling cost is rupees 2,70,000 per year. So they have bifurcated the cost into variable as well as under fixed. The unit selling price is rupees 20. In the year just ended on 30th June 2010, the production was 1,60,000 units and sale were 1,50,000 units. The closing inventory on 30th June was 20,000 units. As soon as you see these three information, that is from here to here, the first thing that should strike you is whenever we are calculating the sale production or with respect to the units, there should be 4 unit information given to you. One is the opening stock, second is the closing stock, third is the production, and fourth is the sales. If any one is missing, you need to do a calculation. So here you have the production, you have the sale, and you have the closing inventory. So what is missing? Opening inventory is missing. So my second working note would be working note 2. Calculation of opening stock of finished goods. So that would be sales given to me as 1,50,000 units plus closing stock of finished goods given as 20,000 units minus the production, that is 1,60,000 units. So my opening stock will be 170 minus 160, that would be 10,000 units. Let's go ahead. So we have done two workings. The actual variable production cost for the year were 35,000 higher than the standard. We'll look into this later. So what is the first requirement? Calculate the profit for the year by absorption costing method and by marginal costing method, and explain the difference in the profit. Explain the difference means we'll have to reconcile the profit as well. So now first, we'll do the income statement under absorption costing. Now, when we are following absorption costing, we know under absorption costing, what do? We convert the fixed cost into a product cost. That means we need the per unit cost. Do we have the per unit cost here? No, we do not have it. So, we'll have to calculate the absorption rate. That brings us to the third working note. Working Note 3. Calculation of absorption rate per unit. So with this, our fixed cost are rupees 3,60,000. Fixed cost is equal to rupees 3,60,000. Now, absorption rate is always calculated on the normal capacity. I told you we will require this in the question. So, number of units is equal to, we can write here working note 1, that is equal to 1,80,000 units. So that brings us to the absorption rate is equal to rupees 3,60,000 divided by 1,80,000 units, that is equal to rupees 2 per unit. Now we are good to go with our absorption costing, income statement under absorption costing. I will take another page, a full-fledged page, so that we don't have any confusion. We have this information ready with us. Whenever we require, we can use this. So let us prepare the format for income statement under absorption costing. I always prefer making the format because with this the answer looks beautiful and the valuer is happy. If the valuer is happy, he gives us marks. Income statement under absorption costing. Particulars. Amount. So let us start with our income statement. Now since it is our income statement, we start with sales. Sales, what is given to us? 1,50,000 units into rupees 20. So that will be rupees 30 lakhs in the outer column. Then we have from sales, if I minus cost of goods sold, what I will get is my gross profit. So let us reach till cost of goods sold. So first I have two production cost. One is the variable production cost and the fixed production cost. So variable production cost. Variable production cost is given to us as rupees 11 per unit. So that would be how many units? This is production cost. So it will be for the units produced. 1,60,000 into 11. So that would be 1,60,000 into 11, 17,60,000 in the inner amount column. Since we are following absorption costing, fixed production cost will be at absorbed rate. Now absorption rate we have calculated at, our absorption rate is calculated at rupees 2 per unit. So we will write here 1,60,000 into rupees 2. Here you can write down working note 3. So 1,60,000 into 3 will give us 4,80,000. Now what we get here is, sorry, it is into 2. So 1,60,000 into 2, not 3. So that would be 3,20,000. So what I get here is 17,60,000 plus 3,20,000. That would be 20,80,000. You can write it in the inner column itself. 20,80,000. This is my cost of goods produced. We have to reach till cost of goods sold. So add opening stock of finished goods. Now opening stock of finished goods, we had calculated the units as 10,000 units. 10,000 units. Do we know the opening balance? Is there anywhere given in the question what is the opening balance or the opening stock value? No, they have not given. So we will assume that the value is similar to the production cost as this year. What is the production cost per unit this year? That is 11 plus 2. That is equal to 13. So here also we'll write it as rupees 13 per unit. And you can make a star mark here and write down a note at the end. We'll write it later. So that would be 1,30,000 less closing stock of finished goods. Closing stock is 20,000 units. Now this value we'll have to calculate. Now there are two ways of calculating this, either by FIFO or by weighted average. We have done this calculation in my inventory, in my stock ledger control account. Here, since the rate is same, per unit rate is same, you take any method, your answer will be same. I am using FIFO. So 20,80,000 is the cost for 1,60,000 units. So if my closing stock is 20,000, what would be the cost for 20,000 units? So that would be 13 as the rate per unit, that, or you can do 20,80,000 divided by 1,60,000. You will get 13 into 20,000. So that would be 2,60,000. If I deduct this, what I get is my cost of goods sold. So that would be 20,80,000 plus 1,30,000 minus 2,60,000. That will give me 19,50,000. So if I minus this, what I get is gross profit. My gross profit is, this would be A minus B, that is 10,50,000. After this I have the selling and distribution overheads. Now again, selling and distribution also I have two parts. One is the variable and the fixed part. So variable cost is rupees 3 per unit. Now this is 3 per unit. Since it is the selling distribution, it will be on the units sold. Units sold is 1,50,000, that is equal to 4,50,000. And fixed cost, we generally don't calculate the absorption cost for selling fixed cost. It is taken as a whole figure because it is on the units sold. And our fixed cost is 2,70,000 given. So that is a total of 4,50,000 plus 2,70,000, that is 7,20,000 negative. Here also you can write negative. So what I get from this is my profit, that would be C minus D, that is equal to 3,30,000. This is our profit as per absorption costing. Now here, as I told you, we'll write a note. Since opening stock value is not provided, it is assumed as same as this year's per unit cost of production, that is rupees 13 per unit. So this completes the answer under absorption costing. Now let us do the answer under, let us prepare the income statement under marginal costing. Again our format. So this would be income statement under marginal costing. Again, starting with sales. Now sales will not change whether it is marginal or absorption costing. So 1,50,000 into rupees 20 per unit. So that will give us 30 lakhs. Under marginal, so less variable cost. Which cost? Less variable cost of sales. So we have variable production cost, that is equal to, variable production cost is equal to rupees 11 per unit, again for the units produced. So 1,60,000 into 11, that will give us, how much was it? 17,60,000. Now here if you see, the actual variable production cost for the year was 35,000 higher than the standard. Under marginal costing we are going to write the exact increase. So we are going to write here, add add increase in cost, that would be 35,000. So we get cost of variable cost of production as 17,95,000. Then add opening stock of finished goods. Now this year this increase is there. Last year this increase might not be there. So we'll keep the per unit cost as rupees 11. So my opening stock, again we know we have calculated 10,000 units. Since again the same thing, the opening stock value is not given, we'll keep it as 11 and write a note at the end. So we have 1,10,000 less the closing stock of finished goods. Now here if you see, last time it was 13, now it is 11. This difference is because of the fixed cost. Less closing stock of finished goods. Our finished goods, we have to calculate the value. I am following FIFO here. 17,95,000 divided by 1,60,000 into, we have 20,000 units as the closing stock. So our value would be would be 2,24,375. Ma'am, why did you calculate value here? Why didn't you take directly 11 here? Because beta, there is an increase. Because of this increase, my value is changing. So what I get here is variable cost of goods sold, that is equal to 1686.25. Add variable selling overhead, which is equal to rupees 3 per unit. So 1,50,000 selling overhead on units sold. So that would be 4,50,000. So what I get after this is my variable cost of sales. Once I add this, it is 21,30,625. If I deduct this from my sales, what I get is contribution, that would be A minus B, that is equal to 8,69,375. Next, less fixed cost. Now we have two fixed costs. One is the production cost, which is given to us as 3,60,000, and the other one is selling cost, which is given to us at 2,70,000. So this would be, I think, 6,30,000. 6,30,000 again in negative. So what I get from this is my profit under marginal costing, that is equal to 2,39,375. This is profit under marginal costing. We again have to write a note here. Same note, since opening stock value is not given, we assume it to be at present cost of production, that is rupees 11 per unit. So this is the statement, this is the profit under marginal costing. With this we have done with part 1. Part 2 is still left, where we have to calculate the difference between the two statements. So we are going to prepare the reconciliation statement. So we have the two profits in front of us. One is marginal and the other is absorption costing. Now if we see, we can start with anything. Let us first start with we can start with either the absorption profit or the marginal profit. Let me start with the marginal profit because this figure looks nice. So net profit as per marginal costing, that is 2,39,375. Now where are the differences? First, if you see here, we have taken the variable cost here as 17,60,000, but here with the increase the variable cost is 17,95,000. So if you see here, the 17,95,000 here under marginal costing, the cost is more. When the cost is more, your profit will be less. Profit will be less means the profit is less under marginal. We are trying to tally from marginal to absorption. So what do we need to do? We need to increase the marginal profit. So add variable production cost. So that would be 35,000. Again I'm explaining, here the cost is more, profit is less. Profit is less here, we are trying to reach from here to here, so obviously we'll have to add back. Okay, but next, now we are going according to this. So we have covered this. The next is opening stock. If you see, the opening stock value here is 1,30,000 and here it is 1,10,000. So again there's a difference here. Now because of this difference, how will it affect our profit? Here the opening stock is less. When the opening stock is less, the profit will be more. So here the profit is more, here the profit is less. We are coming from here to here, so we'll have to reduce the profit. So less under valuation of opening stock in marginal costing, that would be 1,10,000 minus 1,30,000, that is 20,000 negative here. So we have covered this. We have covered this. Let's come back here. Closing stock, if you see here, it is 2,24,000. Here it is 2,60,000. That means it is more here and less here. So if the closing stock is less, the profit is also less. So we have less profit here, more profit here. We have to come from here to here. So less to more, what do we need to do? We need to increase. So our next would be add under. So we have under valuation of closing stock in marginal costing. How will we record that? Again, 2,60,000 minus 2,24,375. That would be 2,60,000 minus 224,375. 35,625. 35,625. Now going ahead, so we have covered this, this and this. Next is variable selling overheads. If you see variable selling overheads 4,50,000 and 4,50,000, so there is no difference here. We don't need this. Next is our fixed cost. Fixed cost, if you see, the production cost is 3,60,000 and here our production cost is 3,20,000. There's a difference here. Why? Because of the absorption. Now here it is 3,60,000. Cost is more means profit is less, and here profit is more. From less profit to more profit, what do we need to do? We have to add back. So now we are going to add the fixed production cost. Here 3,60,000 minus 3,20,000. 40,000 I add back. So we have covered this as well. Next is selling cost. Selling cost 2,70,000 and 2,70,000. So we don't have any difference. Now let us see what is the total difference here that we need to add or deduct. 35,000 minus 20,000 plus 35,625 plus 40,000. That comes to an addition of 90,625. What we get here will be the profit under absorption costing. That would be plus 2,39,375. Tada! We have 3,30,000 of profit, which is matching to our absorption costing. So this is how we prepare the reconciliation statement, or we give the reasons of the difference between our absorption costing, between our absorption costing income and marginal costing income. Thank you very much. I hope this video was successful, very useful, and please keep watching. Please keep subscribing for my next video. Thank you.